Hi there, I'm Bill Warner and I'm with EntreDot. And welcome to Monday Night Live. I can't even mumble it out here. Monday Night Live with EntreDot. Tonight we're going to talk about cash flow. I know you've been waiting for this, that you can't live another day without learning about this boring subject called cash flow management. But I'll tell you something, you've heard this before. Cash is king, right? Cash is king, you must serve the king, and other analogies like that about cash being king. But it really is. You got to be serious about this. Honest to God, if you're a CEO of a company, or the CFO, or head of finance in your company, or you're a subcontractor, accountant to a company, all of you in one way or another have got to really pay attention to cash flow. Because if you don't, it may add to your demise as a company. How's that for a bright picture and something really upbeat here? But look, you've got to really take it seriously, and I know I'm telling little lousy jokes and making fun of it. I mean it to be a very serious subject, and you really need to pay attention. But let me define a few terms that you might have heard bandied around networking events and other presentations you've seen. I'm sure you've heard the term cash flow dynamics. What in blazes does that mean? What's so dynamic about cash flow? Well, there's a lot of dynamics to cash flow. What it means is, in a general sense, is the manner in which and the process by which cash comes into the company, usually as sales revenue or consulting services revenue, and you accumulate that, but you have obligations. So the obligations are part of this dynamic about how you pay for those obligations from the cash you just got through taking into the company. It met a bit days or weeks ago, but you got it into the company. So this flow of cash coming in and cash going out, and what happens in between, and how long it takes, or hopefully how short it takes to convert revenue into cash. All of that kind of working together, the flow and the manner in which it flows, timing mainly, is cash flow dynamics. So if somebody says that to you now, you know what it means. You've heard the term cash position. Cash position, it means how much cash you got. Now you think, well, I'll just go to my checkbook and figure that out. I'm going to leave it at that just for a moment because I'm going to get to it later, but that will be a misleading determination of how much cash you actually have. I'll get to that in a minute, but it's your cash position. When somebody says how much cash you got, you give them an answer coming out of your cash flow statement, not your checkbook or your checkbook register or your last statement from your bank account. Cash flow conversion. This is a period of time that it takes that you've got an obligation for being paid, and the moment in time you actually receive the cash. And again, in between my two hands is time. You want that conversion to be rather short. You don't want to be waiting around for your ability to actually spend the cash when you need it. If this is a long period of time, you've got a long conversion rate, a long period of time before you can actually use the cash that comes into your company as revenue. We'll talk more about how we reduce the amount of time that takes. The cash flow gap is simply a deficit. You don't have enough cash to meet your obligations. And there's going to be a bunch of things I'm about to talk to about how to fix that situation, because that's pretty detrimental. If you owe people money and you don't have the cash to pay them, it kind of keeps the lights on at night, and you lose some sleep over it. So managing managing cash isn't, as I said earlier, not a matter of looking your checkbook register and seeing how much money you got. In this concept of cash flow, cash is a sum total of things. Yep, you can start with, well, where do I stand right now with cash in my bank account? But in the accounting system, we're going to have an accounting for obligations not yet met. For example, you have money owed to you. And by the terms you have with the people that owe you this money, it's going to be paid to you at a certain point in time. And you're going to assume that that's going to happen. So added to your checkbook is some cash that's going to come in a week or two or a day or two, but soon that your calculation of cash flow will take that into account. On the other hand, you've got a number of vendors you owe money to. You haven't paid them yet. So my checkbook says I have $100,000, but I owe a bunch of people $10,000. So, and these are obligations I'm going to have to meet very soon, within the month. So my cash position is minus that $10,000. It's really 80. So those are the two simplest examples of how your use of cash in the near future, let's say on a monthly basis, changes your cash position. So it's your checkbook plus income that you know is going to come in, and outflow, you're going to spend money on bills that you owe. So your cash flow analysis is going to take all that into account. So there's other things that would change your cash flow position, and that is if you are intending to take out a loan. You haven't received it yet, but you're going to receive it within a few weeks. Your cash position is whatever your checkbook says, plus receivables minus what you owe, payables, plus the amount of money is going to come in via this loan you're about to get. So the cash calculation takes financing events into account. So I'm going to leave it at that. There are other complexities to this that change your cash position, but I think you got the point, and that cash flow is a better calculation of where you are with cash, because it's going to take into account things that are going to really happen in the near future. So how do you avoid cash, what did I call it? Cash flow gaps. How do you avoid these gaps? You don't want this to happen to you. So I want to switch gears and give you some hints as to the kinds of things you can do to exercise good cash flow management practices. So you want to make sure that your customers and your vendors, subcontractors, they know what they're going to be paying to you in what period of time. So you should have contracts with them that say this. We're going to invoice you for our services at the first of every month, paid upon receipt. Now that's a tough one to get. You're going to negotiate that, but you want to get paid as early as possible. So you might want to have in your contract, if you do pay upon receipt, we'll reduce this by 5%. So you're giving them an incentive to pay early. So remember that conversion period of time? You set an invoice, and it's not 30 days later, it's 1 day. You've closed the gap on you receiving the cash for somebody who owes you money. That That is maybe the single most important technique you have at your disposal to get money in fast and get it committed, paid to you quickly. You don't do an invoice and wait 30, 60, 90 days later to receive your money. That is awful, particularly for a startup. It presents a lot of problems. I'll get to how some of those problems are solved in a minute. The other thing is kind of obvious, but you'll be surprised at how many people say, oh yeah, I should have do that, is invoice on time. As soon as you finish your obligation with the customer, the next moment in time, the same day if you can, you send them an invoice dated today. Don't wait a week, or don't say, well, I do all of my invoices at the 15th of the month or the 30th of the month. Oh, baloney. Do it the day you have it owed to you. Because the longer you wait, the longer you're going to be waiting for the cash. But worse yet, if you got an add-on period of time that that your customer wouldn't accept anything but 30 days paid, you're now looking at almost 2 months, worst case, on average, month and a half. That's awful. So send your invoices out immediately. Keep track of the payments, for God's sakes. Use QuickBooks or something to make sure you know when you got paid. QuickBooks, if they pay through QuickBooks, a lot of that is done automatically. You just read a report. And you'll get deviations on when payments aren't made on time. So let a tool like that help you. So is having a problem paying you for whatever reason, you'll know right away, and you want to do something about it. So another way of mitigating cash flow gaps is have some form of credit that's available to you. So you may have periods of time where cash dips significantly. It happens when you build a lot of inventory or when you're growing fast. You'll understand what I mean. You may need, for a short period of time, some cash to shore up for this period of time and enable you to be able to pay your bills. So you can get a credit card. If you're a startup, it might not be much, 5,000, 10,000, something like that. Later on, you can get, as you become more credit worthy, that credit card can increase up to 50 in some cases. At some point in the future, however, you're going to qualify because of your credit worthiness for a line of credit with a financing institution, a bank. And now you can be in the hundreds of thousands of dollars of line of credit, have a huge buffer on cash flow issues or cash demand that's unmet by your current cash on hand. So you borrow a little for a short period of time, and as soon as you get the money in from the invoices that you've set out in a timely manner, you pay the credit card off, or you pay back the line of credit, and you're back to even again. So use those two tools to buffer cash flow gaps. So I call these, I didn't invent this term, I call these power invoices. So when you do invoice, make it very clear what you're expecting back and reflecting what you negotiated in the contract you have with them. That you get paid at some point in time that you've agreed upon, but let your invoice say all those words again every single time you send an invoice. So if somebody is standing in for the CFO or a new bookkeeper comes on board, there's nothing for them to remember. You can remind them every month, here's what we've agreed upon, please pay by a specific date. Don't let it be loose at all. Be very specific. It's okay. You'll probably be respected for it. So be very precise in your invoices. I call them power invoices. To the extent you can, to avoid these cash flow issues. When you engage in a contract, particularly a services contract, get as much money up front as you can. It's not uncommon to ask for 50% of your services agreement upon signing. Boom, you probably, at that rate, you probably have covered your expenses for the whole project. So you're now at break even in terms of profit. So you have a set of terms for payment of the rest probably at milestones during the project. In the case of online retail, this is simple. They use a credit card, they pay, money comes out of the credit card, you got it instantly. Kind of a simple and beautiful concept, isn't it? I get paid right now, and now I'm going to ship it to them because I got all the money I need to pay the shipping and everything else. So get payments quickly and invoice immediately. I've already covered that. So those are the kinds of things you can do to avoid cash flow issues. So what if bad things happen and these gaps have caught up to you? How can you remedy them? I've already covered one, and that's the use of credit card or a line of credit. But you also, when people owe you money and they're in arrears, you proceed to collect. This is called call them up and work out a way for them to get you paid. You can't pay me now. Can you pay me Tuesday? Can you pay half now and pay the rest Tuesday? Work out, understand what their problem is and work with it as best you can. But you got a problem child in people who pay late. And sometimes people do that on purpose. You got to catch them on it. If you don't call them on it, they're going to do it again and again and again. You can't stand for that. Particularly if you're a startup, you need money coming in. Another mitigating process is when it's called factoring. When you have a purchase order, or better yet, an invoice that you sent out to some reliable payer, a company that pays their bills, but you got a cash flow gap. I need to get some money now. It's a financing process done by factoring companies. There are people in this kind of business that will loan you up to maybe 75, at best 80% of the value of that invoice and send you the money. Now there's right away. And so you'll have some amount, a good portion of the cash available to you earlier than you would have gotten it from your customer. And they take charge of this invoice and collect the whole thing from your customer and send you the other 15 or the other 20, 25% when they get the money. So that's a factoring process. It's a tool. It's a little bit expensive, but you're not going to use it for a long period of time. So look, I think what I hope you get out of this is that managing cash flow is a lot of moving parts and a lot of techniques you can use to make sure that the amount of time it takes for you to get your cash is less and less and less, managed down to a short period of time because you need the money. So I hope that was helpful. I see a few people on, but I don't see any questions written by anybody. So I'll replay this video tomorrow, as well as if there's time left tonight, but surely tomorrow a couple of times. So you and others you might want to invite to take a look at it, please do so. I hope you enjoyed this just a terribly exciting discussion on cash flow, and I hope you have a good evening. All the best to all of you. Have a great day tomorrow. It's going to cool down, I understand. Clouds are already out here. So again, my name is Bill Warner. I'm with EntreDot. Have a great night.